Chances are, as you've learned more and more about finance, you've heard about the 60-40 portfolio. But what exactly is the 60-40 portfolio? It's considered a classic portfolio allocation that generally should get you the best of both worlds, good growth potential with stocks, and a level of protection with more conservative bonds. But does it work? And is it right for you? Hey workshoppers, welcome back to the channel. Today, let's talk about the 60-40 portfolio, what it is, how to create one, and how to determine if it's right for you. The term 60-40 refers to a method of asset allocation. Asset allocation is dividing whatever money you intend to invest into different types of assets. The goal of asset allocation is to get the best expected return for your money within your risk tolerance. Remember, you want to invest as conservatively or as aggressively as you're comfortable. The 60-40 portfolio is one of the more traditional approaches recommended by financial advisors and experts. Taking this path can make building a portfolio easy, can be relatively stable, if not a bit conservative. But no investment portfolio will fit everyone, so let's take a deeper dive. What exactly is a 60-40 portfolio? The 60-40 method requires establishing portfolios that are 60% equities and 40% bonds. In theory, a 60-40 mix lets you maintain portfolio balance when the market is high and low. It's intended to reduce risk while delivering a steady rate of return over time, even during volatile periods. The main benefit of a 60-40 portfolio is that the bond allocation lowers the portfolio's overall risk. Ultimately, this could help investors with a lower risk tolerance sleep a bit better at night, even through rough market times. How to create a 60-40 portfolio. How you add investments to your portfolio depends on how you invest. DIY investors who are comfortable with a self-directed strategy can build a portfolio utilizing low-cost exchange-traded funds, ETFs. ETFs are mutual funds that trade like stocks. This makes it easy to diversify your investments and take advantage of changes in the market. ETFs are also less taxed than traditional mutual funds because their investments don't change often. There are other financial possibilities to explore. An investor who wants to make money a little quicker could consider putting some of their money into dividend-paying stocks and real estate investment trusts, or REITs. These investments both pay dividends in regular intervals, but be careful. If they're in a taxable brokerage account, you may be taxed on the dividends, even if you reinvest them. Investors can also choose municipal bonds to benefit from tax-free interest on the fixed income side. High-yield bonds are yet another option. They can offer better returns, but they are riskier. You could also select individual stocks. Just remember, stocks that have done well in the past can have bad days or even years, and if you put all your eggs in one stock basket, you could suffer significant losses if that company falls. A small number of big winners have driven the returns on the market, but trying to pick winners is a loser's game for most people. This is why it's often advised to invest in diversified funds. Pay special attention to the fees if you're investing in mutual funds or ETFs. Focus on the spending ratio in particular. This ratio tells you how much of a fund's assets are used each year to pay its running costs. The more you pay in fees to a fund, the less earnings you get to keep. And over time, this could result in tens of thousands or even hundreds of thousands of dollars in paid fees. The downsides of the 60-40 portfolio. While a 60-40 approach is a simple investment method, it has certain drawbacks. The major disadvantage is that a 60-40 portfolio will typically underperform an all-stock portfolio over the long term. It will underperform significantly over long time periods due to the influence of compounding interest. In other words, while a 60-40 asset allocation may be safer, you may miss out on returns. Let's talk about the statistics. From 1926 to 2017, large cap stocks, like those in the S&P 500, returned an average of 10.2% per year. The long-term corporate bonds returned 6.1% over the same period, while long-term government bonds returned 5.5%. An investor who sticks to a 60-40 split may experience returns on both sides. However, they may limit their portfolio's growth by not buying a more significant share of equities. Who is it for? The investor who might benefit most from a 60-40 portfolio is the one whose risk tolerance doesn't let them go for a 100% equity allocation. For the investor who wants good growth potential but doesn't want to stomach riding out extreme markets ups and downs, this is potentially a good option. A 60-40 portfolio has the added advantage of being rule-based. The The allocations are set so you don't have to make decisions about them when the market is unstable. Not having to make too many money decisions when your emotions could be riding high or low can mean preservation of your wealth and the ability to rest easier knowing you have a plan in place. This portfolio style is likely best suited to someone in the middle of their investment career. For example, someone in their 20s or 30s who has several decades until retirement can typically take more risks. They can devote more of their portfolio to equities. This is because they have more time to recover from any market downturn. On the other hand, someone approaching retirement would generally prefer to reduce exposure to stocks and increase holdings of bonds or fixed income securities, which generate more consistent returns at a lower risk rate. If you're unsure whether it's right for you, establishing some ground rules will help. These guidelines should include your time period, meaning how long until you'll need the funds in your account, your goals, risk tolerance, and factors like liquidity and tax efficiency. From there, you can develop a target asset allocation that you wish to maintain and a strategy for rebalancing your portfolio. This accomplishes two goals for you. It provides a clear roadmap and can help you avoid making emotional decisions when the market zigs and zags. The plan's entire purpose is to lead you through volatile times. Your strategy should not change as a result of market fluctuations. Options for the 60/40 portfolio. A 60/40 portfolio can give a sense of stability when it comes to returns. However, it may not outperform other strategies. When planning your asset allocation, it's best to start with a wide range of options and then narrow down to the one that fits your goals best. For example, one rule of thumb you could use is to decide how to divide up your assets based on your age. In some classic advice, you'd deduct your age from 110 to estimate how much money to put into stocks and bonds. So if you're 40 years old, you would invest 70% of your assets to stocks and 30% to bonds. If you're willing to take additional risk, you may increase it. Though this may seem a bit abstract, the basic premise is that the younger you are, the more risk you can potentially take as you'd have more time to recover from a downturn. As you get older, you transition more and more of your portfolio away from equities and toward fixed assets. We always suggest that you consider hiring a financial advisor or planner if you're just starting your investment journey. Finding the right financial advisor can give you clarity and help you figure out where you want to go and how quickly you can try to get there. The bottom line. A 60/40 portfolio invests 60% of its assets in equities and 40% in bonds. The 60/40 split is intended to reduce risk while delivering profits, even during times of market uncertainty. The downside is that it probably won't make as much money as a portfolio made up of only stocks. However, it's a good option for investors who don't have a high risk tolerance but still seek growth potential. Still, each investor needs to look at their own situation and goals to figure out how to best divide their assets. What do you think about the 60/40 portfolio? Is there an alternative asset allocation that you prefer? Tell us in the comments below. We hope you enjoyed this video. If you did, please give it a thumbs up, subscribe to our channel, and click on the bell icon to keep up with the latest videos. Thanks for watching. See you in the next one.